So today we're going Buffett styles. The stocks that you should buy and hold forever. Fellow investors, bonjour. This is Mike Leroux, founder of Dividend Stocks Rocks and passionate investor. You're listening to the Dividend Guy blog podcast where I and my co-host Véronique will help you invest with more conviction so you can enjoy your retirement. Dividend Growth Investors, bonjour, Mike Leroux here. You're listening to the Dividend Guy podcast. I am with my co-host Véronique and his dog looking for attention. How are you doing today?
Well, doing great, Mike. But like these dogs, sometimes they get in the way.
Yeah, I mean, I named the Moose on the Loose my other podcast for some reason, right?
Okay, so today we hit what seems to be a yearly tradition now, our top stocks to buy now and hold forever. And what better timing than our 200th episode to do so? So let's celebrate by doing 2 episodes in the same week. Today we'll discuss the best 5 US stocks, and tomorrow we'll share the 5 Canadian ones, which most also trade in the US market, by the way. So press pause and hit the subscribe button so as not to miss it.
Yeah, it's always fun to do those episodes where we look at companies that have it all, like good metrics, good stories, and plenty of growth vectors to come ahead. I like to think in decades, so whenever I look at a stock in my portfolio, I hope that I'm going to hold it forever.
Mhm.
Unfortunately, it's not always it's not always the case, and this is why it's a good thing that we do that kind of like yearly review about those stocks.
So before we start, this is a reminder that you should not consider the stocks mentioned in this episode as buy or sell recommendations. You must always do your due diligence before buying or selling an equity. Okay, Mike, let's do this. So for the third year, we have found two information technology stocks, Apple and Microsoft. Like we all know these companies, but what growth vectors make them stocks to hold forever?
Yeah, it's not very original, right? But I mean, I've been holding Apple since 2014 in my portfolio, celebrating like 10 years of happiness as a shareholders. I must admit. But yeah, I'm still Apple and Microsoft are two large position in my portfolio, and they will continue to be so hopefully forever. One thing that I really like, because I know like those companies are not really original and you probably know their business model, but they have one thing in common that set them aside is the fact that they have a core business generating ton of cash flow. So for
Mhm.
Apple, it's the iPhone. For Microsoft, it's its software suites, and then they use that cash flow to explore other avenues, other growth vectors. Sometimes it's a big success, sometimes it's a big failure. But since they are able to generate that much cash flow every quarter, they kind of like have an like money is no object for them. It's really about where do they put their attention and their focus and also drive their talents on top of driving money. So these days, Apple has exploded across multiple services. They are now working with augmented reality, and the new iPhone is always around the corner. And I think that they're just going to continue to keep up with this innovation cycle year after year for many decades to come. For Microsoft, well, they can continue to cash on the cloud business, which has been for the past 10 years such a success, and now they invest more money into artificial intelligence, which makes it a very good combination for them because they already sell so many softwares and programs to corporate America. Now
Mhm.
they can just easily and like add all those findings with artificial intelligence, couple them with their software, and just crank up the price with all the service that they sell.
However, Mike, when I look at their P ratio history, both seem a bit overvalued. So why are they stocks to buy now?
Well, again, in this case, it's really about thinking in decades. Of
Mm-hmm.
course, the P ratio is probably one of the risks right now. You're not getting a good deal out of that. You have like Apple and Microsoft are trading like 34, 35 times the earnings. Their forward P ratio is a little bit better, around 31 times the earnings, but still many times in their history they traded at lower valuation. However, considering all the growth vectors that are opening in front of them, I think it's only fair to pay 30 times the earnings at this point. But again, if you buy it now, maybe you'll have to wait a few years before you see a juicy profit coming out of those companies.
And are there any potential risks to consider for Apple and Microsoft, Mike?
Well, I wish I would tell you that they are perfect, but they're not. The biggest risk, I think, is innovation. As I mentioned, they generate tons of cash flow. They reinvest that cash flow into new products, new ideas, but I mean, sometimes they just fail. Microsoft had a long list of poor acquisitions over time. So sometimes they
Mm-hmm.
make a big home run, and then some other times it's a big strikeout. For Apple, we never know how far they can go with the iPhone. And at one point, you wonder like adding a fifth or a sixth camera will do anything to the iPhone sales, right? So the fact that they are depending on that kind of innovation to drive profit moving forward could eventually become a problem. And as we just discussed, the valuation is not ideal either. So I could understand someone that would be a bit reluctant to pour money in those stocks today. But if you're thinking about the next 25 years, probably that it's still a pretty good buy.
All right, so moving on to the financial sector, you've picked Visa as your buy and hold company. I believe it was BlackRock last year, but anyway, while it is part of the financial sector, its rare business model is also influenced by the consumer discretionary and the technology sectors, right?
Yeah, I could have selected BlackRock for another year. It is still the largest asset manager. It is still the largest ETF manufacturer. So it's going to be there for a while. But I just thought of talking about another stock that is, in my opinion, a buy and hold forever. Visa. Same thing with Mastercard, and I could have picked Mastercard. Especially these days, we're going to talk about some downsides that we're going to see coming up. Some dark clouds are rising for Visa these days. But both companies have the exact same business model. They are number one and number two in the market, and they could be classified as one third financial because they are transferring money from one place to another. One
Mm-hmm.
third technology because their ability to transfer such a wide and large volume is mostly based to the strength of their network. So it's really a technology based company. And they will make a lot more money if consumers are spending more and traveling more. So one third consumer discretionary, because if everybody stays home and don't buy anything, well, then they will see revenue going down. And same thing
Mm-hmm.
for MasterCard.
Let's take a quick pause to invite listeners to download the DSR Recession Proof Portfolio Workbook. This guide will empower you as an investor so you can stop doubting your decision and invest with more conviction. What type of tools will they get, Mike?
Well, actually, I created this workbook in 2020 during the pandemic crash to help my members to cut the noise and invest with more conviction. It was a tough period and a lot of investors had a lot of questions. It's a workbook, not a book. It means that there's plenty of questions over there to help you evolve as an investor. And every year I'm upgrading it, adding pages, adding content, and make it more complete. So when you know the answer, you don't stress about the question. And this is how you can invest with more conviction.
The DSR Recession Proof Portfolio Workbook is totally free. Visit thedividendguyblog.com/workbook and download it now. If you already used it, hit the comments and let us know how did it help you. Again, thedividendguyblog.com/workbook. Besides that, why is it a company that you'd keep in your portfolio forever, and what makes it attractive as of late?
So first, as much as I love recurring fees, I love subscriptions, I love recurring fees because they're predictable, they're coming in, and most importantly, they are growing. So
Mhm.
every single time someone uses its credit card to pay something, Visa's making money. Even if you pay off your statement at the end of the month and avoid paying interest fees, they don't care because the interest is not going into their pocket. They're just charging a fee. So it's really the toll road approach where whenever you go to a store and you use your debit card or your credit card, boom, you're going to make money out of it. They're going to make money out of it. So that is an amazing business model. The fact also that they have a network effect. We did
Mhm.
an episode on Modi business, and Visa and Mastercard came back on a lot of moats. So the fact that they have a network effect, it means that the more people use the cards, the more merchants are going to like accept those cards, and then the more people will be likely to use the cards as well. So it's kind of like the flywheel that keeps on running. On top of
Mhm.
that, you're making points on those so you can travel more, and the more you travel, the more you spend, and the more you spend, the more you travel, and then it's going on and on and on. So it's just like like you can see, as much as I'm getting excited about Visa, but yeah, it's a type of stock that will never sound to be a deal, but it's always a deal because it's always going to continue to grow as long as consumers are willing to spend money.
So, besides giving you money for your travels, Visa perfectly fits in the low yield, high growth stocks category. However, what should investors be aware of before pulling the trigger?
Once again, even if Visa has a perfect dividend triangle, there are some dark clouds. And the biggest one right now is the lawsuit from the Department of Justice, the DOJ in the US, about their debit card policies. So the DOJ says that Visa's putting a crazy amount of pressure on merchants, and they're kind of like cutting off all competitors to offer other similar products to just keep up with their almost like duopoly with MasterCard, but for debit card, it's even larger. So, of course, that is a lawsuit that is going to drag for years. On one side, the DOJ has virtually unlimited fun to go after the company. And on the other side, well, let's be honest, Visa has virtually unlimited fun to keep up with this battle. So it's not going to be a matter of like months or years. It's going to be maybe a matter of like 1 decade before this problem is being solved. One thing is for sure, there are a lot of lawyers that are going to be able to buy themselves nice Porsche every single year for a long time, maybe a villa in Costa Rica as well. So lawyers are going to make a lot of money out of that. It's going to draw attention. It's going to be a distraction, and it's going to be an expense for Visa moving forward. The other thing that goes a little bit along with this line of thought is the fact that merchants are not that happy to pay expensive fees to both MasterCard and Visa. And as an
Mhm.
example, a few years ago, Amazon tried to ban Visa transaction in UK. That lasted about a week, but still, it just shows how there's like kind of like a grudge here where a lot of merchants are tired to have to pay fees to transfer to accept payments. On the other
Mhm.
side, consumers decide. So if they want to pay with their card because they're making points and because they're traveling, well, then there you go. You're going to have like a strong demand for that. But then again, that is like the biggest problem I can see, and it's fascinating to see how Visa and MasterCard were created and were almost presented back then as a monopoly that became like just two companies, so a duopoly. But on the other side, it's kind of like a necessity to have such a strong company that you can trust and that is able to manage this load of volume.
Mhm.
So it's really hard to tell them that we don't want them anymore, or they should split their companies into like 10 different smaller companies. But on the other side, I can definitely understand why the DOJ is running after them. it sounds a lot like they are abusing their position of strength.
All right, so I'm glad that you selected the next one because it's also part of my portfolio. And it's another classic for investors, Johnson and Johnson, J&J. What long-term value can it bring to investors?
Yeah, once again, not very original, but J&J is in my portfolio. It was one of the first dividend grower I bought back in like 2011 or 2010. It's been so long I cannot even remember. Johnson Johnson as a great diversification in terms of revenue base. So they have the two-thirds of their business coming from big pharmaceuticals, so all like the drugs that they develop, and one third selling medical devices. So they used to have, well, it used to be like what it is today, Kenvue, which was their like Tylenol and all the consumer healthcare products. They
Hmm.
spun that off last year, I think, in 23. And now they're a pure play on pharmaceutical and medical device. One thing that I really like about this company is since they focus on specialty drugs, they have a lot of pricing power, and they are harder to manufacture once the patent expire. So we also how AbbVie had to deal with Humira sales going down rapidly once their patents expired, as the generic pharmaceuticals were able to produce like the same drug with the same formula.
Hmm.
But for Johnson & Johnson, the fact that they just focus on complex drugs, it's just like so costly that the advantage of being able to replicate the formula is not that much of an advantage considering the fees incurred.
So its recent struggles with lawsuits for that one too have caused its stock price to drop for a while, but it seems to have returned close to its previous level. So why is it still a good investment today?
Well, it's the same thinking here. If you're thinking in decades, it's going to be a lot better than focusing on short-term
Hmm.
problem. I remember when I bought J&J, there was a huge recall in 2011 for their Tylenol product, and that cost them like 1.4 billion. So similar to today with those lawsuits, you're just looking at that and just thinking, "Wow, this is not a good time for this company." But they have been able to learn from that mistake, making better process, avoid recalls because that is quite painful.
Hmm.
But yet after that decade that the stock did well, it's not a type of business that I expect to drive my portfolio to higher level, but rather stabilize it. It's a
Right.
business that I expect growing a little bit more around mid-single digit in terms of total return instead of like double digit like Microsoft or Visa or Apple that we just discussed. But it's good to have that kind of like stabilizer in your portfolio too.
And we've mentioned lawsuits, but what are the risks associated with J&J?
Well, on top of lawsuits, recalls could always be there. And one major thing is the innovation. They need to generate bunch of cash flow, and the big part of that must be reinvested in research and development. The problem is you're not always making money developing new drugs when you invest in research. Sometimes you just invest in research and nothing happens out of that. So
Hmm.
this perpetual work to find other drugs and maintain your drug pipeline like in a good health, and always have like new blockbusters coming up, especially with the size of Johnson & Johnson these days, to make it a significant difference to grow the business and push revenues higher. This is definitely a challenge for them. They've been able so far to do well, but it's always something that you have to review from time to time.
Now, a new one on the list, automatic data processing, ADP, is an industrial stock that has caught your attention for a few years now. What makes it one to buy and hold forever?
Yeah, this one I'm a bit mad about myself. I should have bought it a long time ago. I don't even know. I don't even have a reason why I didn't buy it the first time I looked at it. I mean, the company shows a perfect dividend triangle. When you look at the revenue, the earnings per share, and the dividend growth trend, it's almost the same numbers. It's almost the same pace. It's just perfect. And here's the reason why nobody changes their pay services ever. I mean, I work at the National Bank for 13 years, and for 13 consecutive years, I've received the exact same pay stub, like the same logo all the time. Fortunately, the pay stub increased over a year, but it was always the same logo. And same when I started my business at DSR. Well, I just like got a payment service system in place and it's rolling. And the last thing I want to do in my day is to look for another one. That's not going to bring me anything. And it's just a pain to change. And that fact that it's a pain, if you are a major player such as ADP, makes it like one of the most stickiest business model ever, because no big
Mhm.
corporations wants to stop paying like 100,000 employees and just change their payment service altogether. I mean, imagine the costs and what are the real benefit from that. So again,
Mhm.
we have discussed Modi businesses a while ago, and we have said if there's a steep learning curves, if there are costs attached to switching from one provider to another, chances are you're going to stay there almost forever. Or unless the service is a complete disaster, well, ADP is reinvesting. They're introducing AI into their services as well. They make sure they are on top, and they deserve they offer a high quality service, and for those reasons, they're going to be there for a long while.
Mike, after all these years helping investors and retirees, we found a way to create a dividend income for life, and you will share this in our upcoming public webinar. So let's pause the episode a bit and invite you, listeners, to this special event. We will hold a live webinar on Thursday, November 28th at 1 p.m. Eastern Time. What will attendees learn, Mike?
Well, first, as a dividend investor, you just want to live off your dividend and enjoy your retirement. That's the ultimate dream. However, there is a big problem with dividend investing, and a lot of investors are blinded by the yield. So, we're going to talk about that. We're going to tackle the dividend myth. And I'm also going to offer you a different way to see how you can structure your portfolio with high quality company that will not fail you, and there you can still create that dividend from your portfolio. This is why we call it dividend income for life. We did that webinar last year to celebrate our 10 years anniversary at DSR. We had over 2,000 investors that watched that webinar. So I'm expecting a lot of questions for the Q&A. It's going to be a lot of fun. So I want to see you there on November 28th. And of course, if you register and you cannot attend, you will receive the replay.
So, like you said, Mike, after the presentation, we will stay around for a 1 hour Q&A session. This is your chance to ask Mike your questions and get straight answers. Of course, the webinar comes with some freebies, and I'll be in the chat to assist you. So save your spot now for the live session or to get the free replay at thedividendguyblog.com/webinar. Again, Thursday, November 28th at 1 p.m. Eastern Time. Create a dividend income for life at thedividendguyblog.com/webinar. With a dividend yield and a P ratio under historical averages, ADP currently looks attractive. What could explain its undervaluation, and what are the downsides of this business?
Well, first, it's not a really exciting business when we're thinking about the Nvidia, the Google, the Meta, the Tesla of this world. I mean, now we're talking about like a pay stub business, like offering
Mm.
like HR services. Kind of boring, kind of repetitive, but this is exactly what I love about it. The other thing as well is the investors could be afraid that we are not getting the smooth landing that we seem to get it. But I mean, when expert predicted that we were going to have a recession, and I was also agreeing with most financial analysts 2 years
Mhm.
ago. Well, we didn't get it. And now most financial analysts think that we're going to have a soft landing. So maybe they're going to be wrong a second time. Who knows? So, and that's the thing. ADP is cyclical. So if there are less people working, it means less revenue for ADP. So that's definitely a downside. It will go as well as the economy goes in terms of growth.
Right.
The other thing is competition. So while they have a very sticky business, what could limit their growth moving forward is acquiring less new clients. If new competitors with like better technology or innovation grab those clients. So it's one thing
Mhm.
to retain what you have, but then we're always thinking about how can you grow, because retaining in the business is surviving, and you usually don't survive that long. You have to be in offense mode most of the time. So thinking about that, ADP must always be one step ahead of its competitors. So that's definitely a challenge, an ongoing challenge for them.
Okay, so the last one for today is in the consumer discretionary sector. And I know you're a regular at Kanak, Mike, but Home Depot, HD, is the industry's dividend growth stocks, right?
I can just imagine how many people are wondering what the hell is Kanak.
Yeah, I know.
I
I've done it on purpose.
I know. I mean, for those who do not live in Quebec, Kanak is a home renovation retailer. I'm not even sure if it's present outside of Quebec, to be honest. But anyways, that's for the story. Home Depot. I'm a big fan of Home Depot, to be honest. I often go there as well. It's the world's largest home improvement retailer. Cannot do better than Home Depot. So the thing is, you cannot really use AI to renovate your kitchen. You'll need actual lumbers and other products that you will find at Home Depot. HD is serving both DIY homeowners and also pros. One of their most key characteristic is that since they are the largest retailer in this industry, they are also everywhere. And being everywhere means that they have everything, and for pro contractors that is amazingly convenient. So they go there, they get what they need to go on with their day, they go back on the property that they are building or renovating, and they can continue to work fast. They also operate one of the largest website platform for e-commerce in the world, with a huge load of transaction, and they use similar to Walmart, how they use their existing store. HD will use their store as a distribution hub as well for their e-commerce platform.
So, Mike, what are the risks investors should know about Home Depot?
One thing is the limited growth potential. So while they are the world largest retailer, they're mostly in North America. And at one point, I guess there's a limit of how many stores you can open. One tip here is for retailers or restaurant chains, a key metric to follow is the comparable sales. So the sales from the same store from one year to another. If they are able to grow organically, that's great, but they will need also to find other markets to open new stores in maybe other countries. The other thing is, of course, it is a highly cyclical business. Over the past 2 years, we have seen with the rise of interest rate that a lot of people, they do not buy a new home. They will limit their renovation to something that is more cosmetic, like painting,
Mhm.
instead of like spending $100,000 in a new kitchen. So that will also hurt Home Depot sales. So you always have to expect some kind of like a roller coaster. The dividend triangle will never be perfect for that reason either. You will go through phase where the revenue and the earnings are going to be stable or sometimes on a bit of a slowdown, especially what we see right now in 23, 24.
Okay, so now, Mike, in the end, what criteria really matter when selecting a stock to buy and hold forever?
So it always starts with financial metrics. Companies with a strong dividend triangle, and if you look at any of the companies mentioned today, you will see that over the past 5 and 10 years, the revenue, the earnings per share, and the dividend is growing steadily. So that's the first thing. And then the second one is you need a strong investment thesis. You need a strong narrative explaining the success and telling you how this success can continue to be repeated. Because it's one thing to find a breakthrough, make a lot of money out of it, but eventually you need to be able to repeat that playbook over and over again. And those companies that we have discussed today, they have been around for a long time, and they have proven they are able to repeat the same plays and find growth vectors over and over again. And I think that this is the repetition, the history of a long streak of growth that is a key for a buy and hold forever company.
And by the way, listeners, if you wonder what the dividend triangle is, we did an episode explaining that recently at thedividendguyblock.com/195. Well, thank you, Mike, for pulling this list of fantastic dividend growers. Listeners, ensure your portfolio and investment strategy are aligned by downloading the recession-proof portfolio workbook at thedividendguyblock.com/workbook. For the show notes and related content, visit thedividendguyblock.com/200. Tomorrow in part 2, the best 5 Canadian stocks to buy now and hold forever. Make sure to hit the subscribe button now to avoid missing it. And until then, stay invested.
Hey fellow investors, it's Mike here. I hope that you have enjoyed this episode. Please note that the Dividend Guy Blog podcast is at no time issuing buy or sell recommendation. Please do your own due diligence, as this podcast is recorded for information and hopefully fun purposes only. Make your research, make sure you do your stuff. We're not responsible for your losses or your profit after listening to this episode. And until next one, stay invested.